Good morning. How commercial lenders view risk differently. And commercial lenders don't approve deals based on emotion. They approve them based on risk adjusted returns. And that's the fundamental difference that most borrowers miss. And if you've ever wondered why a deal that looks really good and still gets declined, the answer almost always comes down to how lenders define and measure their risk. And here's the reality. Commercial lending is not about the borrower itself, but it's about the asset, the cash flow, and the exit strategy. The core principle there is think like a lender, and residential lending is borrower driven, whereas commercial lending is deal driven. So, a commercial lender is going to ask different questions. So, will this asset generate predictable income? Is there enough margin for error? And if things go wrong, how do we get repaid? And that's it. Business plan and exit strategy is what they're after. And the five risks that commercial lenders care the most about will be cash flow. So DSCR is king, and the debt service coverage ratio, or DSCR, is the primary filter. And debt coverage is your net operating income divided by your debt service. And most lenders want north of 125. It's up to 135 as a minimum. And if the property doesn't produce enough income, the deal just doesn't work, regardless of your credit score. Two is loan to value. Lenders want a buffer. Typical range is 65 to 75% for financing. And the lower the loan to value is the lower risk and in turn better pricing. The more equity you have, the more protection the lender has. So debt yield is an institutional metric, and sophisticated lenders will focus on the debt yield of their investments, which is basically the net operating income divided by the loan amount they advanced, targeting, say, 8 to 12%. And this tells the lender if we had to take the property back, what's our return going to be? Four is asset quality and location. And not all real estate is equal, and lenders will evaluate your market strength. So if we're in Houston, a major metro, versus a tertiary market, or your tenant quality, but also your lease structures, your triple net versus grosses, what your renewals are looking like, as well as the property condition. And a strong asset can compensate for a weaker borrower, but not the other way around. Five is exit strategy. And every loan is underwritten twice: how it performs today and how it exits tomorrow. So lenders are going to ask, can this refinance? Can it sell? And what happens if rates stay high? And if there's not an exit strategy that everybody gets comfortable with, then there's no deal. So let's talk about why borrowers get declined even when the deals look good. And most borrowers think, I have good credit, or the property looks solid, or the numbers work on paper. But lenders see thin cash flow margins, potential over leverage that might make sense with more cash in, or weak tenants, or a property that just doesn't really have a clear refinance path. And structure is going to beat the story every time. So let's talk about how mortgage brokers change the outcome. And this is where working with a broker changes everything for you. And a strong mortgage broker is going to help match deals to the right lenders. So banks, your debt funds, SBA, debt coverage lenders. And we can structure loans around your debt coverage, your loan to value, as well as your exit strategy. And this helps position the deal like an underwriter would. And the difference isn't the deal itself, it's how the deal is presented. So let me give you a real world example. And two investors submit the same property. So investor A sends a rent roll and an application, whereas investor B has looked at his debt coverage, the debt yield, the exit strategy, and the tenant profile. And guess who gets approved faster and which gets better terms? Well, investor B is going to win every time is the point. But preparation is definitely worth its effort. So commercial lenders don't think like borrowers. They think like risk managers. So if you want approvals and better terms and faster closings, start thinking like the lender before you ever submit the deal. And my call to action for you is if you're buying, if you're refinancing, or if you're structuring a commercial deal in the next 12 months, let's build the deal right away before it ever hits underwriting. It all starts with the conversation. My name is Bill Rapp. I work with a company called Medallion Funds. You can visit my website at billrapponline.com and figure out how to get a hold of me. Love to talk to you more about your situation. Hope you have a good day.